So it took me over 10 years to realize the cover calls are one of the worst, hands down worst stock option strategies to use ever. I made a lot of mistakes in my day in stock options, and I can promise you, cover calls are one of the worst strategies that you could ever do. In this video, I'm going to break down exactly why they're horrible and a much, much better strategy to use. I built a 7-figure account without doing cover calls. I will almost never do cover calls. There is a very, very rare edge case scenario where I will do cover calls, and we're going to cover that. A lot of covers here that we're talking about, but you're going to understand why cover calls are not going to be what you want to do. Let's dive in. All right. So, conventional wisdom with cover calls essentially tells you to do this: go buy 100 shares of a company that you like, buy the shares, use those shares as collateral, which is the cover call. That's why it's called covered. Use those shares as collateral to sell cover calls. You collect this cash flow every month or every couple weeks, whatever duration you decide to do it on. If you buy the shares for $100, maybe you set your 1 month cover call at $105 strike price. If the share goes to 105, hey, you sell your shares for $105, you made $5 per share. And on top of that, you collect this monthly premium. So a lot of people really get sucked into this idea that, hey, I could collect monthly premium month after month after month on these shares that I already hold in my portfolio anyway. So, like, why not just keep doing this? And once you get your portfolio to a certain level, call it 100K or whatever people say you could get it to, and you could basically live off the cash flow, you're good to live the rest of your life and never have to work again. That is what most people push on to people right now. But there's a humongous, humongous problem with that. Because while that sounds good on paper and while it might work out in a real world most of the time, there will be a couple of times where something is going to play out in a certain way that if this happens, you are going to wish that you did not sell cover calls on your shares. Let's dive into the charts. Let's talk about it. Okay, so I have a chart here of the NASDAQ pulled up, and it doesn't matter what stock we do it on, what ETF. What I'm going to say here is going to apply to everything. And I guess before we dive into this chart, we need to lay the groundwork for what a cover call actually means and what you're trying to achieve in your portfolio. So, cover call means you hold the shares. So let's just say you hold 100 shares of Triple Q, which is the NASDAQ. If you want to sell a cover call, you could sell one contract because one contract is 100 shares. You own 100 shares, you could sell one contract of a cover call. So, what do we want to do with these two trades in our portfolio? How do we make money? Well, if you buy shares, we obviously want the share price to go up, right? You want to make a lot of money on the shares as they go up. But when you're selling a cover call, what do you necessarily want to happen? Do you want the share price to go up? Do you want it to go sideways, or do you want it to go down? Cover calls are technically a bearish strategy. So when you think about that, selling a cover call basically means you're bullish and bearish at the same time. While some people say, well, oh, Brandon, you could just set your strike price way higher and way out of the money than what the share price is technically trading at right now. So you're never going to lose your shares if the share prices go up. That is factual in a way, but there is going to be a scenario that plays out where your shares are going to gap up, they're going to go way, way higher, and you're going to leave a lot of money on the table. So, as you guys know, the number one thing that moves the price of a stock in the long term is what earnings per share does. This line right here corresponds to what the earnings per share growth does for the NASDAQ. With that being said, the NASDAQ is going to follow this line up and to the right. Remember, cover calls, you own the shares, you want the share price to go up. That is likely to happen in the long term with the NASDAQ. But when you sell cover calls, like let's just say that we're selling a cover call right here where my cursor is, look to the right, a $538 cover call for call it a month out right here before Liberation Day tariff dump. Yes, you're going to do fine on that cover call. You're going to be able to keep your shares. You're not going to get your shares called away from you because the index fell roughly 22%. So while you feel super smart that you sold your cover call and made a little bit of premium, did you make enough premium to cover a 22% downturn on the stock price? Like, you didn't even get close to that. So again, you feel smart collecting your little cash flow, but you held the bag down on the shares 22%. So you didn't really look too smart after that. And on top of that, let's play the sentiment factor here. Let's play the emotional aspect here. What does the herd want to do when the market is falling right here? They want to buy puts, and they definitely don't want to buy calls. So while this market is falling and while this market's getting cheaper, the herd is not going to say, I want to buy calls. The herd is going to say, I want to sell calls. Let me get rid of these graphics right here. It'll be a little bit easier to see. So the herd wants to sell calls down here, but it's the exact wrong time to do it. Why? If the herd usually loses money in the stock market and they don't want to buy calls when things are getting cheaper, which is when you should want to buy calls. But they're just the herd and they want to sell calls because they think the market's going down, it's going to keep going down. Like they literally think the market's going to do this right here. Like this is how they see the market going, just straight down. But that's not what's going to actually happen. The market is eventually going to rebound. So while they see in their heads this is what the market's going to do as they're reading all the news headlines, they are going to sell cover calls on their shares. But there's a major problem with that. Because while this market fell to roughly $418 right here, maybe they're going to go sell a 400 and we'll just call it $60 cover call roughly about a month out. What happened in this time frame was not only did the shares rebound from this low level of roughly 415, but they went all the way up in that same time frame that the cover call expiration date's going for to over $529 a share. So it's like you sold your cover call at the worst possible time when there was no demand to sell cover calls, when there's no demand to buy calls. So your premium that you're selling these calls for is going to be low. On top of that, you sold your shares here where you could have just been patient and not did the cover call trade at all. And you could have rode these shares all the way back up on this rebound right here. So while you might feel smart, while you might feel like a genius that you're collecting this weekly or monthly cash flow, whatever you're doing, you're probably going to leave a lot of money on the table. Now, when the market trades orderly and it doesn't really go up or down too much, yes, you can make a little bit of cash flow by selling cover calls. But if we really honestly be real with ourselves here, how often does a market just simply go sideways? Like it doesn't ever do that. The market is either going up or it's going down. It doesn't usually go sideways. So while maybe when the market's going down, it does make sense to sell cover calls, most of the time the market is actually going up and you're going to find yourself being on the hook to sell your shares when you actually want to hold them and ride them higher. So what I like to personally do with cover calls is when I feel like the market is expensive, when I feel like the market is overvalued, that is when I like to sell cover calls on shares that I hold. Because again, think about this. If you have the shares in your portfolio, you are bullish, right? Why would you want to limit your upside on shares if you are bullish? I can't tell you how many people, let me just go back to the chart and show you NVIDIA. Where is NVIDIA on this list? Here. I cannot tell you how many people down here, NVIDIA split a few times, we know that. But how many people down here were saying, oh, I got NVIDIA for 12 bucks a share. I'm going to go sell a cover call right here for 30 bucks a share or whatever this is. Yes, you went from $12 to 30 and you made money. But dude, look at this big move that you missed right here. You feel like a genius because you collect a tiny bit of cash flow and you sold your shares for a double. But dude, you missed the boat. You missed the big move. That is not what you want to do. You do not want to be bearish on these quality companies in the long term. You want to be bullish. And you can't have NVIDIA shares in your portfolio and then sell cover calls at the same time and say that you are bullish. You're bullish and bearish at the same time. So you're just betting against yourself. That is not what you want to do. Again, in a minute, we're going to go into a strategy that is a bazillion times better than this, but I do want to go back to when it does make sense to sell cover calls. All right, let's go back to Triple Q. So let's go back into this example right here. Let me delete this line and I'm going to add another line right here. So in this pump right here, this is what most people in the stock market thinks that the market's going to do. They think it's just going to keep going up, up, up forever. Eventually, the market is going to take a correction and go down a little bit. So up here, when I felt like the market was a little bit expensive, what was I doing? This is when you want to start selling cover calls. But why is that? Well, when the market gets a little bit expensive, the future expected returns are going to be a little bit lower. So while yes, it is very, very hard to time the top in the market, it is more compelling when things are more expensive to sell cover calls because we don't think the market's going to do this. We think the market's going to do something like this, just go sideways for a little bit. And while we did get this dip right here and all the cover calls that we sold on its way down were doing good, we knew that this dip right here was going to be temporary and we did not want to sell cover calls forever. So while the herd is up here thinking the market's going to do nothing but go straight up, they're willing to pay more for a call option, right? They're going to pay top dollar because there's demand for that. So when there's a lot of demand for a call option, the premium that you pay for that call option is going to go higher. When the premium goes up for the call option, guess what? We could sell them those call options for more money for the same contract because the herd just wants to buy more call options. It's very, very simple. And this also works on the flip side with my other strategy that is makes me a lot of money, guys. Over 30K a month, the strategy makes. We'll talk about that in one more second. But again, the time to sell cover calls is up here when the market's hot. The time to sell cover calls is up here when the market's a little bit hot. The time to sell covered calls is not going to be down here when the market is cheap. The time to sell covered calls is when the market is hot. You want to go when the market's hot because your future expected returns are going to be a little bit lower. So while you might think you're doing something good by collecting this monthly cash flow, you are not doing something good. You are simply basically on a hamster wheel just making a little bit of money. And while you will make money on 9 out of 10 of your trades, there will be a time where your company that you're selling cover calls on, there's going to be a crazy positive catalyst that's going to come out, or the market's just going to go up and it's going to carry your company with it, where you're going to find yourself on the hook to sell your shares for $100 a share, but the current price is $150 per share. So while you might have bought them for 50, sold them for 100, you left a lot of money on the table because the current market price might be way higher than what your strike price is, what you're selling your shares for. So I usually never sell covered calls. I know that it's a very popular thing to do, but if you haven't been burned by them yet, you eventually will be burned by them. And if you have been burned, please comment below and tell your story, because a lot of people will read those comments and they'll get a lot of value from that. I've been burned on covered calls before, trust me. Like, I'm not saying I never fell victim to this, but I learned from that. And now that I scaled this account to 7 figures, I know that cover calls are a major, major trap, and I'm very, very careful to not do that. When the market's hot, yes, I will do it and I will generate a little bit of cash flow. I will pad my downside. But also, the thing that not many people talk about is this. Like, let's just play devil's advocate again against myself. Brandon, if you think the market is expensive right here, why are you going to sell cover calls and collect this cash flow on the way down? Like we talked about right here, how the NASDAQ fell roughly, call it 35%. NASDAQ fell 35% right here. So why not, instead of holding the bag down, why not just simply sell your shares and not have to hold the bag on the way down? Because you're not going to collect, like, let's just say you have $100,000 worth of Triple Q stock right here. You're not going to generate $35,000 worth of premiums because 100K is going to go down by $35,000 right here. You're not going to generate 35K of premium on the downside. So why not just sell your shares, wait for things to get a little bit more attractive, and then do a bullish option strategy instead? Because again, everybody wants the market to go up. The board, the CEO, the shareholders, the employees, everybody wants the share price to go up. It's not going to happen in the short term, but in the long term, it's going to go up and to the right. So why not just sell your shares when they're expensive and then enter back in when things are a little bit more compelling when it's lower? That is something that you could consider doing. Again, timing the top of the market is very, very hard. Timing the bottom is very, very hard too. But you don't have to necessarily time exact tops and bottoms. You just have to capture the gross movement, is what I talk about. The gross movement essentially just means this. Hey, the market's a little bit overvalued. Hey, the next couple years it's probably not going to do that much. Or hey, the market's pretty cheap. The next couple years it's probably going to go up a lot. Do not sell cover calls down here. Instead, let's talk about my more bullish option strategy that is 100 times easier to make money with, and you could generate monthly, weekly, whatever type of cash flow you want. You could generate cash flow with this strategy. Okay, let me move myself out of the way a little bit. We're going to draw a new line on the chart, and I'm going to show you why this strategy is a bazillion times better. Okay, so this line right here, again, this line is going to correspond to the earnings per share growth of the companies within stock, the ETF, the whatever. Earnings per share growth is what moves the price of a stock in the long term. The number one thing, it's not your Fibonacci, it's not your Bollinger Band, it's not your whatever you think matters. The profits matter for what something is going to do in the long term. But in the short term, we're simply going to use short-term volatility as a way to capitalize and use a different option strategy to make a lot more money. Okay, so what we're going to do down here, while the market's cheap, how are we going to generate cash flow? We're going to sell put options. It's so simple. We're not going to sell put options as spreads. We're not going to do complex 5-legged iron condor strategies, whatever you think you're going to do. We're going to keep it very simple because simple wins in the stock market. You're going to sell put options down here when the market is cheap because a lot of people are freaking out. The herd is panicking. They're willing to pay more money for downside protection, which is buying a put option. And we are simply going to sell them that put option for top dollar. We sell the put for top dollar. We buy shares and we buy calls. And we be patient and we ride that to the upside. What duration are we going to pick for selling puts? Usually 1 year. 1 year is way easier because look at this line right here. In 1 year, it's clearly going up. But if we go just like 1 month, like, yeah, it went up a little bit, but it's hard to really say what the market's going to do in 1 month. We just simply don't know. So when you extend your time horizon to roughly 1 year and you find a compelling dip like this, All you have to do is sell 1 year or 2 year put options, generate big cash flow down here. So maybe a 1 year put option, you'll generate $12,000 versus the 1 month put option, you'll generate $1,000. Sell a 1 year put option down here, generate 12K while the market is cheap, and then spend maybe 6K on buying calls and 6K on buying shares. You're likely to get free calls and free shares at the end of the day because those put options are probably going to expire worthless. Because as earnings per share goes up, the market is going to rebound to the earnings per share growth line with time. It's not going to happen in a week, it's not going to happen in a month, but eventually it will. The market's going to follow what earnings do in the long term. So I know I covered this pretty high level right here. I didn't really go too deep, but I made a very, very, very good video for you guys. I'm going to link it right here. Watch this video. It is more detailed into how I do stock options. You have to watch the entire thing. It's going to help you out a lot. Just trust me on this. I'm not clickbaiting you. Watch the entire video. I'll see you guys there.